managed futures manager that I love, Wisdom Tree, has a managed futures ETF, and it's performed very much in line with the index for managed futures, and it's liquid, so you can get in and out of it at any time.
Thank you so much for tuning into Journey with Christian D. Evans podcast. I'm your host, as always, Christian D. Evans, and we have a very special guest on today. He is the managing partner at Chapwood Investments, which has the unique ability to recognize how current events affect investment portfolios. Okay, he has been recognized, internationally recognized, as an expert in the investment, wealth management, and personal finance industry. He was featured in Broke, the critically acclaimed ESPN 30 for 30 documentary that chronicles professional athletes and their financial expertise, and the most popular Sports Illustrated article ever, How and Why Athletes Go Broke. So he works with a lot of athletes as well as a lot of celebrities. He has also been 29 years plus in the financial service industry, beginning at Morgan Stanley and scaling that first advisor to surpass almost $1 billion AUM, which is incredible. He's been appeared and featured on the Blaze TV and is Blaze branded contributor for the Blaze Online. Additionally, he is op-ed contributor who has written articles relating to financial topics for National Center for Policy Analysis, Fox Business, Fox News, Breitbart, and so many others. He regularly talks about wealth management and other timely subjects related to finance and investment on radio shows around the country, including Mad Dog Radio and Bloomberg Radio. He has been the keynote speaker at IMCA Winter Conference, lectured at the Private Wealth Texas Forum, T3 Conference, Yale University, NYU Stern School of Business. So you feel like you think you should listen to this episode to the full capacity, as well as maybe share this with a friend, a colleague, someone that's struggling? You bet your ass you should. Please welcome my friend, the managing partner at Chapwood Investments, the one and only Ed Butowsky. How you doing today, Ed?
That's the best introduction I've ever had.
Well, man, I am excited about it and very humbled. And one of the things I actually found so interesting, and you called this out on your website, and this is where I want to start because I thought this was just so incredible, and I think this is really good context. Because there's some people that are listening and say, oh, I've got my wealth management, I've got this investment portfolio, I got this. But you say this on your website, chapwoodinvestments.com. Although we firmly believe that 97.5% of all portfolios are inefficient and are taking far too much risk for the expected rate of return. Let's build that. How can you say that? And I'm just curious, what is that approach in regards to that data?
Sure. So first of all, most portfolios are broken. In fact, 97.5% of them are, because 97.5% of investment portfolios don't have non-correlated assets in them. And the only way you can have non-correlated assets, meaning not everything going up and down together, is to have alternatives in your portfolio. And most firms don't allow their advisors to recommend alternatives. And if they do, they keep them below 2 or 3%. But this is one of the biggest problems. But I actually wrote a book called Wealth Mismanagement. And it came about because I realized, after being in the business at Morgan Stanley for all these years, I realized that what we were saying was very different than what people were talking about on the institutional level. Meaning when people go to foundation meetings and endowment meetings, there's a different conversation that goes on there than it does when you're talking to an individual investor. So the retail broker hasn't been properly trained on how to manage and measure risk. And that's one of the biggest problems I see. So in a way, I think our whole industry, is poorly, the people just don't have a clear-cut understanding of what they should be doing, and the advisors don't. And it's not because they don't want to, it's just the training is not there at Morgan Stanley and Merrill Lynch and UBS and even Goldman Sachs. They don't train people on how to construct and measure risk in a portfolio, but we'll look you in the eye and tell you we care about you, we're going to take care of you. But how do they do it? How do they measure it? And most people don't know that.
Well, let's dive into that. Okay, so what are the red flags? What are the green flags that, like, my audience and myself should be aware of when we are allocating and having these conversations with our wealth managers?
Well, the first thing you need to do is look at the historical relationship between your historical rate of return and your standard deviation. And your standard deviation is the measure of volatility. And the higher that number, the worse the performance of the portfolio is going to be over time. So if you had a historical rate of return of 10 and a standard deviation of 15. What that means is that 95% of the time, your returns would be between plus 40 and minus 20, which isn't very good. That means that at any point in time, in a 12-month period, your advisor will tell you that basically your portfolio's returns are going to be somewhere between plus 40 and minus 20, and they can't tell you which one it's going to be. So you need to narrow that. So you need to have a standard deviation that's 80% or less than your historical rate of return. Now, this might sound really wonky to people, but what they should do is go to their advisor and simply say, if I had a portfolio with a rate of return of 10, what should my standard deviation be? And this is a catch-22 question, because if the person doesn't know, then you should walk away. And if the person gives you an answer, then you should find out if it's true. And I'll tell you right now, I'll do it for anybody free of charge. I'll do their evaluation for them, and you'll see that almost none of them are 80% or less. It's just, I'm sorry,
Well,
go
I
ahead.
appreciate you explain. No, this is incredible because you actually talk a little bit more about this. You kind of talk about it. Investment forensics is what you call it, where basically you've designed extremely intelligent analytical tools that easily spell out how efficient your current portfolio is by measuring the 8 most important metrics. And you go on in this video talking about rate of return, not lose principal, standard deviation, variance, drag, fan of tax, and I apologize if I'm messing this up a little bit. Sharp ratio, probability of loss, numbers, money at risk, upper and lower return, correlation between S&P 500. Now, I'd love for you to, and I know because I mentioned a lot there, and I'd love for you to just tear that apart one piece at a time so that we can understand it. In this video there on your website, you kind of explain that in a very kind of 30,000 foot view, but I'd love for you to just unpack that. You mentioned, of course, standard deviation, something that we should, like a red flag or a green flag that we should be aware of. I'd love for you to just unpack that a little bit further for us.
Sure. So your historical rate of return, I start off with, I have something called ChapVest. I have all these weird little tools that I've created. And I didn't create it myself. I directed somebody. I don't know how to code anything. But the idea is that most people don't know what they need to make in order to not lose purchasing power. So, some people think, well, if I'm making 7%, I'm doing fine. Well, after you take taxes away and after you take away the real cost of living increase and you take away your management fee, are you making any money? So the first thing is you need to know what number you need to make in order to not lose purchasing power. Then standard deviation, which I just talked about, is a volatility number. And you said a red or a green flag. It's going to be a pink flag or a red flag. Because very few people have green flags where it all looks good. But if you have a rate of return of 10, you need your standard deviation to be 8 or lower. And if it's higher than that, you're taking too much risk for the expected rate of return. And then I get to variance drag phantom tax, which is something that I made up. I know that William Sharpe won a Nobel Prize for the Sharpe ratio, and I thought, well, maybe I could win something for variance drag phantom tax, VDPT. And VDPT is simply that number, which is 0.8, which is the standard deviation relationship to the rate of return. And you can simply evaluate a portfolio by simply looking and saying, I have a variance drag phantom tax of 0.8, and right there you have a very good portfolio. If you have a variance drag phantom tax of 1.5, you're taking way too much risk for the expected rate of return, which, by the way, is what the stock market is. It's a historical rate of return of 10 and a standard deviation of 15. And so you should ask your advisor, what is my, standard deviation? What should it be? And you're going to find out that they don't know. But, right there, in fact, is exactly why you need to have an analysis done, because most people are taking too much risk for the expected rate of return. Then the Sharpe ratio won a Nobel Prize in economics, William Sharpe, and he won a third of the prize in 1990 for modern portfolio theory. And you want that number to be 1 or higher. Then the amount of money at risk. The next one is the probability of any loss in the next 12 months. You want that to be 15% or less. So again, your ideal portfolio is you want a rate of return that is commensurate with what you need. You want your standard deviation to be 80% or less. You want the Sharpe ratio to be 1 or higher. Obviously, you want your variance drag phantom tax to be 0.8 or lower. You want the probability of any loss in the next 12 months to be 15% or less. the amount of money at risk, you want that to be as low as possible. And you want the bandwidth of the probability of rate of return versus the loss to be as narrow as possible. So if you had a rate of return of 10 and a standard deviation of 6, that means you have just as good a chance of making 22% in the next 12 months as you do losing 2%, which is a lot better than making 40% and possibly losing 20%. And then the next thing you want is the correlation to the S&P. That means you don't want everything going up and down together, because if everything went up based on a positive economic event, then everything go down when that positive economic event changed. So you need to have investments that can go up when others aren't going up, which is a whole other discussion, but an important discussion to have, because a properly managed portfolio should always have some assets that aren't doing well. And that's why my hair is so gray and yours isn't, because I have to live with this every single day. Someone will call me up and say, hey, I like this, this, and this, but what about this? And I have to remind them, remember, we have non-correlated assets, because at some point they're going to be called on to perform when others aren't. And our job is not to guess, as opposed to what people think. Our job is not to try to guess which way the market's going to go, is to have a portfolio that's always prepared for anything.
Well, one of the things that when I was preparing for this podcast, one of the things that I found was this how you laid that out so beautifully, because there are certain things and red flags that I was not even aware of that I should become aware of, like you just mentioned, which is the standard deviation. I found that very interesting, as well as that Sharpe ratio, explaining those certain metrics. This is what portfolio looks like in order to make sure that we're on the right path. I want to ask you a little bit, and I love this approach, which you just mentioned there, and I think a lot of individuals I've talked to, they don't when they're looking at that 8-9% return, they don't also put in and say, hey, what's that cost of living increase, because you're fighting against inflation, you're fighting against taxation, and you're fighting against as well as the fees. So I'm just curious, when you've and maybe you can and cannot say this, I'm not sure, for regulation purposes, but what have you noticed in regards to like the average for new clients, their rate of return, and then when you actually net of fees and net of tax and net of cost of living, how much are they actually realistically net
Right.
interest?
That's a great question, because I oftentimes, I know I'm doing a podcast right now and this is going to go public, but I often wonder, am I improving people's lives because of their relationship with me? And I like to think I do. But we also have to look at it, factually, and look at the raw numbers to see, after the rate of return, after subtracting the cost of living increase. And I don't use the CPI, because the CPI is a bogus statistic. The real number is much higher than what the CPI is. And then after subtracting taxes and the cost of living increase, are you doing better as a result of your relationship with your financial advisor? It's a great question. My numbers are going to be different depending on the client and what their goals are. That's a nice way for us to hide behind the reality. But I like to think that we do a better job than most. But we're very honest about it, and we try to put everything out on the table so everyone sees things, versus hiding behind this veil of uncertainty and head fakes that brokers tend to do, and try to change different things so clients don't really follow them very closely. I like things to be pretty black and white.
Well, yeah, and I see this a lot, even myself, sometimes we do talk about these fancy vehicles. They have fancy names, and you're not really sure exactly what those vehicles do. And I want to ask you a little bit. I have seen an evolution of the original portfolio, maybe 10, 15 years. It was very similar to like 60-40 split portfolio management. Now we're starting to see a lot, definitely the high net worth and ultra high net worth, which is kind of your niche. That's who you kind of work with majority, where they're allocating a little bit toward alternative investing. I'm curious. I know it's very contextual. It's depending upon obviously that client's goals, where they're at, etc. But I'm curious, how do you approach that in regards to allocating some toward that has outperformed the market, alternative investment?
Yeah, and again, the reason you invest in alternative investments, this is important to understand. It isn't because you want to get a great rate of return. You invest in alternatives for non-correlation, and because that's how you reduce the volatility in a portfolio. So over time, we've gotten to have a lot of liquid alts, and there's many alternative investments that you can invest in that are in the ETF form. I invest in a lot of hedge funds, a lot of the big managers, D.E. Shaw, Citadel, Millennium, Third Point, and a couple of others. And then I also have recently started putting money into private equity, Vista Capital, Silver Point, uh, and a couple of others. I just can't remember offhand, but I've been putting those into different funds. But then we get into the venture capital side, and that's where people, and I did this in the movie Broke. And I also wrote another book called Never Go Broke, an investment guide for professional athletes. And in there, I talk about the liquidity line. And the liquidity line is where you should never put any money below the liquidity line until you have $3 million put away. And below the liquidity line, you have real estate where you should be getting 15% net on your investment. Private equity, you should be looking to get 5 times your money in 3 years. And if you're not going to get that, you should not invest in it. And then you have venture capital where you're looking, to put very few dollars and hoping to hit a home run. But you should have no money in those until you have $3 million put away. And then with real estate, you should have about 7 to 12% of your money. In private equity, you should have 0 to 10%, and venture capital, you should have 0 to 5%. And those they come at me all the time. Every day I get emails about different ones, and I try to respond to everybody who sends them to me, letting them know that the likelihood of me doing this deal is very unlikely, but I respect anybody who's reaching out and trying to pitch something, because it's very difficult to try to pitch something to anybody and get their attention. So anybody watching this who wants to pitch me, I will respond, but it'll probably be a no. But the ones that I like are the liquid alts and the ones that have really strong management, that are institutional quality hedge funds. The bigger hedge fund managers I really like working with the most. Pershing Square is another one that has a higher risk profile, but I enjoy working with Bill Ackman quite a bit. I actually went to high school with Bill. So those are the ones that I like to do. Then there's also the publicly traded REITs that some people would say are alternatives to in some respects, and public storage REITs. I do not like retail REITs at all, but I do like big industrial REITs. And then for a riskier side, the hotel REITs tend to have a lot more bang for the buck because they're a lot more risky than the commercial real estate.
So I love how you just unpack that at a very micro level. So you're saying baseline. I love those hurdles too, like those kind of key metrics that people should be hitting. $3 million before you start looking at all these alternative investing. And then what happens is you said, correct me if I'm wrong, 0 to 15%, depending upon obviously contextual their situation to real estate, 0 to 10% in private equity potentially, and 0 to 5% in the VC. Again, it's all contextual, depending upon their situation. Correct?
But let me correct something. The alternatives are above the liquidity line. The hedge funds are above the liquidity line. What's below the liquidity line is real estate, where you should have 7 to 12% of your money, and that's after $3 million. Then 0 to 10% is in private equity, and 0 to 5% is in venture. And it's just, all of those are highly illiquid, and therefore you should demand a bigger return for your money for the risk that you're taking.
Appreciate that clarification. So that's how you structure it. And I loved how you really emphasize this in regards to even at a micro level regarding private equity and what they should be expecting in regards to the result. And this is kind of the baseline and saying if you're doing a 3X, probably not the best fit. You want to get a 5X in private equity, for example. And that was kind of the situation you mentioned.
You want to get 3 times your money in 5 years.
There we go. Okay, gotcha. Well, see, I'm so glad we're reiterating this. I appreciate that. And also in regards to you tend to go more toward liquid investments, like you mentioned. Why is that? What is your thesis behind that?
Yeah, because most clients want to know when they can get their money. And I've been at this so long, I hate the conversation where say, yeah, well, it's tied up for another year or it's tied up for 6 more months. And if you can get a similar result with a liquid alternative, then you should go with that. But there's certain managers like D.E. Shaw and Citadel, like D.E. Shaw Composite, hit, knocked the cover off the ball last year, was up 25%, and you couldn't get that in a liquid alt. And their numbers are so good that it's worth being locked into them. But at the same time, with managed futures, there's a managed futures manager that I love. Wisdom Tree has a managed futures ETF, and it's performed very much in line with the index for managed futures, and it's liquid, so you can get in and out of it at any time. So it's really driven by the client's demand more than anything else. And thank goodness liquid alts have come, to be as they are today, very available. So people can invest like institutional investors, even if they don't have, tens of millions of dollars.
That makes perfect sense. And I want to ask you in regards to the illiquid alternative investing things. Okay, real estate, private equity, and VC. What do you recommend, or how do you have that conversation after they have a liquid event in those alternative investors? So it's 5 years, they sell it, cool, exit, whatever it is. Now they have a chunk of money. How do you reallocate that? What does that contextual situation look like? Do you shove it right back into those investments, or either let it grow? I do know it's very contextual depending upon what their circumstance is, but like, how do you have that conversation? What's your perspective on that?
Well, regardless of how much money someone has, because I've had people, with $100 million liquid, I always have a conversation about income, because no matter what, people need income. They want to feel as though they're making money off of their money. So the first thing we solve for is whatever income that they need. And I always overemphasize the amount of income that they're going to need. And I have a client right now who has $30 million in cash, and he's picking away at little like chunks of it into private equity deals. And I talked to him the other day and I said, slow down, because there's always going to be a private deal, but we have to make sure we take care of the income part. And, you're always going to want to have 5 or 6 million. I can't believe I'm saying this, $5 or $6 million coming in, to your mailbox. And he's like, yeah, you're right. I love people like that, but we solve for the income portion first. Then we solve for dividend growth. Very boring stuff. Then we start to get into some of the esoteric things. And I actually like hard money loans. And I like litigation funds. I've been looking at those quite a bit. And these are non-correlated assets that can reduce the overall risk in a portfolio that have nothing to do with the stock market. And I've actually started looking into wines as investments. Diamonds I love versus gold and silver, because you can buy diamonds at 30% off or 40% off of what they're worth, but gold and silver, you buy it exactly what they're worth. But diamonds, you can buy them off of what they're worth. It's called the wrap list. And it's not just because I'm Jewish I know this. I just know this. And this is a great way to buy diamonds, because diamonds move up and down with gold and silver, but you're buying them cheaper. Then looking at trading cards, sports cards, and crazy as it sounds, purses are also a great alternative. So there's a lot of other ways for people to invest money than just in the public securities, but you have to have an expertise in that. And I don't necessarily have an expertise in all of this, but I know people who do. And that's what's nice about being an independent RIA, is that we can be a little more flexible with what we recommend to clients, because not everybody makes all their money and should make all their money doing what we do, because we only have certain things we can do, but there's a lot of other ways that people make money, and I like recommending those as well.
I'm a big believer, and I love what you're mentioning, non-correlated assets. And if you could maybe unpack this for us, like by adding XYZ non-correlated assets into your portfolio, how much does that risk come down in regards to that whole portfolio? What does that look like?
Well, it depends on what that
Right.
alternative is, but traditionally, if you're putting it into hedge funds, you're looking at a correlation of about zero point 0.2 to zero point 0.3 versus value investing, where it would be large cap stocks, where you have a correlation to the S&P of 0.99. So it just depends on what amount that you put into it. But I'll tell you, there was a study done at Wharton. I was there for their executive MBA program, and we did a study where we took all the assets that existed in the world, and put it in an optimization tool and hit a button and said, give us the best mix of returns or best mix of assets that give us the best rate of return with the least amount of risk. And 89% went into hedge funds. So hedge funds traditionally do very, very well for clients, and their returns are excellent, and the risk is very, very minimal. But people have this idea that hedge funds are Bernie Madoff, and if you just watch the Madoff special, you'll know that Madoff never invested in a hedge fund. He never made any trades. It was just a complete con job, and it's a shame that he did that, because he destroyed the reputation of a phenomenal asset class. And I invest in that asset class, and have for a long time, and will continue to, because it's the right way to invest people's money in certain categories. Not every hedge fund is the same, by the way. That's like saying, I eat fruits like you're going to eat every single fruit. There's certain fruits you like better than others at different times. Same thing with hedge funds. There's 13 different broad-based styles of hedge funds. And you should look to see which ones work for you, and then decide if the liquid portion is appropriate or not for you.
That's a good analogy, by the way. I love that. Fruits. Everybody, there's a lot of fruits, but doesn't mean you like all of them. Also, it's very interesting on a side note to see how I'm noticing the hedge funds are trying to rebrand themselves into something else. I don't know what they're going to call themselves, but I'm noticing because it's got such a negative connotation toward it. But like you mentioned, that's really interesting. I did not know that. Was not aware of that research to see that hedge funds. Now, let's. I want to stop here for a second. And how do you look at the proper hedge fund? I hate these questions because it's so contextual depending upon that client and so forth. But I just want to ask, like, at how you look at, you've been in the industry for many years, and there's a lot, like you mentioned, there's a lot of verticals within the hedge fund space. And so how do you go about, kind of picking the right ones and so forth?
Well, getting capacity in some of these hedge funds is very difficult. I work through a company that has access, because each hedge fund has 499 slots, and some of them have less than that. And to go up there and say, hey, I have $10 million I'd like to give you, they're going to say, no, my minimum is 100 million, and I don't have a slot available for you. So the first thing I do is I look to see what capacity that they have, and then I look at the correlation to the S&P. Millennium has an incredible track record of a 10% rate of return with a standard deviation of 3, which means that their variance drag phantom tax is 0.3, which is amazing. And they haven't had a losing year in, I think, 20 years. And so if I had access to Millennium, I would certainly be investing in them. So I look at the historical rate of returns and the correlation to the S&P. I like managed futures. I've always been a huge supporter of managed futures. When I started at Morgan Stanley, I was one of the top managed futures people there, and really got to know it. And I love what they do. They're trend followers, so they don't make any predictions. They just look and see if there's a trend, and if there is a trend, that they get on that trend, and then they get stopped out, and then another trend begins, and then they start to go long that trend, and they just take all the mind decision making out of it. And I like that quite a bit. That has not performed very well the last 5 years, but I do believe that this is the time that managed futures is going to do well. Then you have statistical ARB, which is really for brilliant people. I'm not one of those guys, but these are the people that have letters that are upside down that are somehow numbers, and they understand what it means. I don't understand a lot of their black box strategies, but they, just like with the D.E. Shaw Oculus, is a statistical ARB fund, and they have a negative correlation to the S&P, and they've performed very well. So a lot of this stuff is gaining access and getting capacity of some of these managers, and then determining if their correlations make sense or not.
Yeah, it is interesting, definitely in this field, because like Ray Dalio, I think his minimum, you have to have basically $1 billion and to be able to even work with him or even have a conversation. So a lot of these hedge funds, there are pretty high hurdles, and so that you do have to work with a wealth manager and kind of pull the money together. So it is interesting, but it's interesting you mentioning this, that it outpaces and it's actually outperforms even with all that algorithm and that research done. I want to loop back around in regards to non-correlated assets. You were talking about a few other assets that you're kind of entertaining a little bit in regards to like precious metals. Do you ever get into the art world as well? In regards, I've seen some interesting thesis in regards to high net worth and ultra high net worth and where they invest. What is your perspective on that?
Right. I do not know the art world at all. And I always look for deals, and I don't know how you get a deal in the art world. I don't know if I look at these people who run galleries as hucksters. I just don't know what to make of them, and there's no way that I can reasonably have a conversation about it. I just know that I'm not into NFTs and any of the crypto stuff, and I would avoid the NFTs like the plague. Uh, but when it comes to actual art, I would defer to somebody else to tell me. And that's the nice thing about, again, being independent, is I can rely on other people that I deem to be very smart. And but when it comes to art, I'm not the guy, and I'll be the first one to tell you that.
No worries. I was just curious because you did bring up those other, precious metals. And I was like, oh, let me ask him about art because I have seen some people they deploy some capital in there, and I'm just like, this is so crazy to me in regards to like the value of it and the growth. So it doesn't make any sense to me either. So it's interesting. Ed, I want to talk a little bit about these individuals like you mentioned. You have this principle. You obviously are figuring out, okay, what's their lifestyle want like, and that consistent income coming in. There's this metric, and then you build upon that, which is that portfolio. I want to talk a little bit about in regards to generational wealth, in regards to like what kind of structure they should be having that conversation, what that looks like, and other tools that these high net worth and ultra high net worth should be, asking themselves, and vehicles that they should be familiar with. And I'm not just talking about like some of these individuals that are listening to our podcast. They've had an exit and they've got some cash, cool, but they want to structure it properly to think, that now they're thinking, generational, their kids and their great grandkids and so forth and so on. So I want to ask, like, not specifics, but I'd love to ask in regards to that conversation with some of your clients, that do think that way, and how are they thinking about that?
Well, I do have clients that have generational things set up, and most of them are set up in trusts and other 678 plans, and they're they're but they don't like to give up control of the management of it. But they still feel, no matter how much wealth they have, and no matter how old they are, they don't want to give up control over those assets for their kids or their grandkids or future generations. I'm seeing a lot of positive things when it comes to the younger kids learning. I'm very, very happy that they're being engaged. I do a lot of classes for younger people so they can learn about this, because the parents or the grandparents don't have the um, the tendency or the the they're not in a position to teach about asset management, because a lot of them don't know it themselves. They know how to create wealth, but they don't know how to manage it. But I have a lot of people. I have this one young guy named Sean who I've known since he was 12. I've been managing his family's money for, I guess, about 20 years now, and he's come into his own. He's got money. He got about $4 or $5 million on his own, and he understands things very well because I've been teaching him, and his father's been teaching him. And I think that that's a trend that's going to continue for quite some time. It could be because of the internet. People have access to information and they're able to absorb it. But I'm definitely seeing a lot of positive steps towards generational wealth, which is different than what you see, sadly, in the athlete world, because the athletes don't necessarily learn up front, although they should, and they should be taught by people like me. And I want to make a comment about that, as long as I brought it up, that it's not an athlete's fault if they don't understand something. It's people like me. It's our fault for not teaching it in a way for them to understand things. Because the idea that an athlete is dumb is just not true. I mean, to look at how they have to adjust defenses and offenses, and these are some really, really bright people. They just haven't been taught how to manage money. And that's because the financial advisors haven't taken the time to teach them. And it's like a message on advertising. If you were advertising a product and someone wasn't buying your product, whose fault is it? It's yours, the advertiser's fault, because you didn't communicate things effectively for someone to go buy your product. Well, if somebody doesn't understand something, it's my fault for not communicating it properly. Well, the same thing holds true with generational wealth. And I do believe that the younger generation is starting to pick up on things and starting to learn a lot more at an earlier age than they used to.
Well, and that's one of the things that one of the reasons why I want to have you on our podcast because I love the responsibility that you bring in regards to educating properly and communicating properly, and aligning, this amazing vehicle and this complicated investing world and all the lingo and all the technical babble and making it simple so that they understand, okay, what is the clarity, what is the result, what is that portfolio, what is it doing, right, and simplifying it, right? And I think that's very important because it's like we all I like me, you get in a vehicle. I don't know all the bells and whistles of all the lingo of that technical vehicle, but I understand how to get it from point A to point B, and that's kind of what you're able to do with your a lot of clients, and it's just simplifying it. So I think it's really awesome that you have that responsibility. You mentioned something, and I want to kind of loop back around on it because I found this intriguing. You have you've been able to work with a lot of high net worth and ultra high net worth, and you've seen a lot of turmoil, definitely in the sports and celebrities. You mentioned obviously you want to educate them, and there is tailwind behind it in a good way, a positive way. You're seeing that. What else do you think culturally that we could do to make sure that we're maximizing that? We are seeing democratization of education, which is really good in regards to the financial world. There's a lot of people who are very passionate about that. Um, but what are you seeing right now in regards to some other steps that we could be, headed the right direction to make sure that we have that right foundation?
Yeah, I mean, I'll tell you, it's going to sound ridiculous, but I think that everyone should just listen to me, um, because I find that when I started this new movement, and it started with the article in Sports Illustrated, How and Why Athletes Go Broke, I initiated that article with Richard Demont at Sports Illustrated. I'm the one who got that article written. And then we turned that into the movie Broke on the 30 for 30. And what got this movement going has also hurt it because so many people have decided they wanted to get into the education for athletes and protect them, but they didn't have the background to do that. They had familiarity, but it'd be like somebody wanting to be a dentist and saying, hey, I'm your friend, let me take care of your dental work. Well, there's a skill set that you need to have, and it's not just caring for these people, it's actually knowing and understanding things. And so I've put together that book, Never Go Broke, an investment guide for professional athletes, because I was frustrated with how things were going and how the education was going. I saw a lot of people just putting people in annuities, and people didn't realize they were putting $40 million in an annuity. Well, that advisor or the person who put them in just got $2 million, and they're locked into it for 10 years. And that's just not the right way to manage money. But they appeal to them because of safety and saying, hey, you're never going to have to worry about anything. But there's lots of issues with everybody wanting to help, but not having the ability and the knowledge on how to help them. So, kind of kiddingly, I would love for everyone just to, pick up my book and read it. But knowing that that's not, going to happen, what needs to happen is there has to be some sort of laid out, foundational work for people to do. Read a certain book or listen to a book called Understanding Wall Street. It's been out for 45 years, and it gives you the basics. But there's also one other thing. I guess I got to stop myself. Is that the idea that an athlete has, because they might not have finished school, or they didn't do well in school, or they didn't study finance in school, they have in their mind that they're not able to learn certain things. And that's just not the case. So anybody watching this, you can learn this stuff if you just look at the right places and start reading and understanding. It's not that difficult. If I can learn it, I'm not the smartest guy in the world. If I can learn it, anybody can learn it. And I assure you that, I mean, I've taken guys like Torrey Hunter, I've taught Kevin Durant, I've taught so many people about investment management. And I will tell you that it's not that difficult to learn if you have the person who's teaching you the right way.
And just on a personal note, how does that make you feel to be that catalyst for these individuals? Because you could be the one, like you mentioned, where you help them build out that foundation strategically. You know what you're doing, you know how you're doing it, and you're literally setting them up for generational wealth, and you are able to make that impact. How does that feel, Ed?
Oh, I love it. I absolutely love it. I love taking care of people. And I used to have a very, very high minimum. Now I don't have any minimum. I just like dealing with really good people. I fired a client that had $1 billion with me. It was the dumbest business move I ever made, by the way. But I don't care how much money you have. I care about making a positive impact on your life and feeling good. Money doesn't drive me, although I need to have it to survive. But that's not what drives me. It's the competition that drives me. And I love competing every single day. And I love it. I always tell people that my job is to make sure that you can protect yourself against people that look and sound like me, because I look and sound like every financial advisor. And I want to protect them and know how to protect themselves against people that look and sound like me.
Well, I can tell the energy and the passion that you have and the impact that you're making consistently now and what you did in the past and the future here. So again, I really appreciate you being on here. I want to talk a little bit, get a little personal. We mentioned this offline and you a few years, maybe a year back, I think is what you mentioned, you had some health issues that you had to work through. And at the same time, you were obviously still building, you were still making that impact in people's lives and running your business successfully. But there was, on and off. And looking back now throughout that journey, what lessons did you learn?
Well, I had a health issue where I had a hip replaced and it became infected, and I had 13 surgeries, and eventually I had a cement spacer for 8 months where I couldn't get out of a chair. But what I realized was how much I loved doing what I do. And thank goodness for video conferencing, so I could work from home. This was during a period when COVID was really bad. So some people were working from home no matter what. But I I realized that my job doesn't end. A financial advisor's job is not like from 8 to 4. If you're Central Time, 8:30 to 3 o'clock. We're never ending, and we're always thinking about our clients, and people also, they care about you. But I also realize that people mainly care about what you can do for them. So, even though I know people cared about my health, and there were some people, some friends that came over often and checked on me, um, I realized that this is very much a business, and I had to persevere through it, and I did. I didn't miss a day unless even when I was in the hospital, I spent about 60 nights in the hospital a year ago, and on and off, and I was still working, and most of my clients didn't know, because I had a good group of people that I worked with. But at the same time, I made the effort to make sure that people were always being taken care of, because that's what they care about. Their sympathy and empathy only goes so far, especially if their portfolios aren't doing well. Thank goodness portfolios were doing well when I was in the hospital. But I appreciate you bringing that up, because I haven't thought that much about it. But I suffered for 5 years with this, and I wasn't able to walk. And anybody who knows me knows I still walk with a little bit of a limp today. But the infection's gone, and I'm back ready to go.
I'm always impressed with people when there is that physical thing that happens, but also you have to at the same time focus on building and sustaining your business consistently. So you have to do both, and both takes a lot of your time, energy, and mental capacity. So just on the mental. testing that mindset, testing that, mental, fortification for your own mindset. Ed, how did that test you and maybe your just mental capacity, or maybe, things that you had to work through and say, Ed, you got this. Ed, I'm a winner. Things that you had to work through to make sure that you, stayed that synergistic, consistent energy.
Yeah, it was really the lesson of empathy that I learned in third grade, because I realized that if someone's calling me or somebody's out there worrying about their money, I have to empathize with what they're going through, and I'm the one who's supposed to answer their questions and their concerns. So, if they're concerned about something, I need to empathize with them and put aside any of my things that are going on in my life, and realize that this person is in need of me, which makes me feel good. I like feeling wanted and needed. And I enjoy that quite a bit. But I enjoy also, the thing about this business is, it's a great thing I have ADD, because there's always something new going on. Something's going on in Iran and China and the Middle East, and and trade surpluses, and there's always something happening that I have to calculate in my brain, and I love that. But my clients expect me to be aware of what's going on in everything. So you could ask me a question about anything in the world today, and I'm going to have an answer. It might not be the right answer, but I'm going to have an opinion. That's for sure.
That's awesome, dude. And you just remind me of a very relational person. You treat your clients almost like family, right? Their problems are your problems, and you're very empathetical in regards to, hey, you know what, and you drive with such a responsibility. And I think that's why, you got probably incredible clients, and they understand that as well. Ed, for those that are listening, and they probably didn't understand half the things you said, and they're like, okay, I need to talk to Ed and his team. They want to reach out, have that conversation. I know you've been featured in all different places. Obviously, I'll put some of that content down below. But outside of that, how do they reach out to you? How do they be part of what you got going on, Ed?
Yeah, they can reach out to my office at 972-865-2225. And we normally just set up a Zoom, and we talk about what's going on in their financial life, what their goals are, their aspirations, and I try to, again, teach. I teach everybody. I want everyone to understand everything. So I do that. And then my website is chapwoodinvestments.com. And there you can see the investment forensic toolbox. And some of those tools you can do on your own. The financial distress calculator is something that I recommend everybody does. And ChapVest is something else that I recommend everybody does.
Awesome, guys. Those links will be in the description below. And Ed, I appreciate you make yourself so available. You put your phone number as well. So I'll put that down there so they can just grab that, a hold of that. And then again, I would recommend chapwoodinvestments.com. They've got tons of resources. They got all of his media, blog, asset management, investment forensics. So incredible amount of content that you can learn and understand throughout your wealth management. And like Ed was talking about, ask those questions about your standard deviation and what that looks like in regards to what your portfolio. If they don't have an answer, well, what is it? And you got to figure that out. And that's kind of a red flag or a green flag depending upon their answer. Ed, again, I appreciate you just talking about your 8 pillars, this amazing conversation, as well as your personal journey that you had to walk through, but really fortify, but also build that empathy even stronger, and that amazing family and synergistic kind of relationship you have with your clients. Ed, I always love to ask my guest before I let you go, is there any last words of wisdom they'd like to share with our audience?
Um, no. I would just say that your financial advisor should know how to measure risk. And if they don't, then get a new advisor.
Well said. Well said. Guys, that is my friend, the managing partner at Chapwood Investments, Ed Butowsky. Guys, that is Journey with Christian David's podcast. Until next time, be uncommon if you can.